you improve a society? This is undeniably a question that any society would have, and the Western world really seems to have answered that question by providing more freedom. If you want to maximize the well-being of your citizens, more freedom seems to be the best way to do that. And what comes with freedom, consequently, is really more choice. If you're free to do things, you're then free to choose what you want to do. And that's where I think there might be a little bit of a misunderstanding. The belief is since choice is good, it's always good, no matter what. And I'm not so sure about that. So that's what we're going to talk about today in relation to your financial plan. How do you as an investor sift through all of these different choices that you have? What's the order of operations? How do you know if you should do a Roth 401k or an ESPP? How much you should do to either? How do you know if you should do a traditional 401k or contribute monies to your college plan? There's a money formula for each of us. And that's what we're going to talk about today. How do you maximize your wealth by getting that order of operations straight for yourself? My name is Michael MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. I'm joined today by Abby Foster, who's also a certified financial planner with Mariner Wealth Advisors. This is Your Life Simplified. Abby, how are we doing?
Hi, Mike. I'm doing well. I'm a little sore today, but doing well.
What are you sore from?
So we here at the Mariner headquarters started this running club back in January of 2020, right before the pandemic. So we had 2 solid months where every Tuesday after work, we'd all go run a few miles together. And we just started it back up again. And me, being the smart human I am, decided to join on one of the hottest days of the whole year yesterday. Not the brightest decision on my part. I'm feeling pretty sore, but it was still good for me. I kind of need that accountability to do things that are good for me. So was happy to have the crew around me yesterday for sure.
Yeah. That first wind, if you will, is kind of unavoidable. It seems like when you're getting after whatever it is for the first time, like with basketball, like there's only one way to get in basketball shape. You just got to go play. And the first time can be a challenge. I hear you. So in regards to this really topic for today of what is my money formula? What is the order of operations? How do I know what I should save to first? You obviously practice as a CFP with clients. What is kind of that first step that you see a lot of times that makes sense for folks to take?
Yeah, for sure. So really kind of the first step when we're first meeting with a client, first sitting down, is really just get to know them, right? Who they are, what their value systems are, what's important to them. Because that really drives what their financial goals are. And that's really the whole point of money, right? If it doesn't help you achieve your goals, what's the use of it? So that's really where we like to start, Mike, is when we're creating a financial plan, really just start with the goals. What are our priorities here? What are we trying to accomplish? And from there, it's really just about getting organized and making sure, we have accounts all over the place, your retirement plans here at maybe one custodian, your IRAs, your Roth IRAs at a different one. You have maybe a health savings account or, various different other sorts of plans. You have your bank accounts. They're all over the place. And so what we like to do is just start off by getting organized. What do you have? Where is it? And can we put it all on one page so you can see across the board what you have? And so that's really important, just knowing where you're starting from. And then the next step is really, where do you want to get to, right? So we know where you are, but what is the next step? What do we need to do to order to achieve the goals that you've set out for yourself, right? And so that's really where that financial plan comes in, and where we kind of determine, okay, these are your, discretionary monies that you have in your, cash flow plan. So where can we best deploy those to achieve these goals that you have?
Yeah. Yeah, and that can be a reality check of sorts, right? And that's where sometimes people are like, okay, so you're defining goals first, but then you're coming back to this third step of defining goals again. It really is redefining them based on, what's there, because unfortunately, most people, they're not as clear as maybe they should be on what their goals are and how they're tracking for them. Right. And so I think that third step is definitely critical. And, in regards to today, There's just so many options that people have, so many different choices that they have to make on their own. I mean, if you just think about the traditional employee at like a tech company, or just any large firm, you're going to have traditional compensation. Then you're going to have a 401k that's traditional, a Roth 401k, an ESPP, might have some RSUs, you might have some stock options, you might have a deferred compensation plan, you might have an HSA, an FSA, and in each of those, you have likely dozens of fund options. So you start thinking about the combination, the multiples, and I don't think our intuition guides us right here. I mean, that's a lot of different combinations. I mean,
Mhm.
quite literally thousands, if not tens of thousands of combinations just in the way you set it up. And probably in the millions if you consider the dollar amounts that you can allocate to each of them. So no wonder people are a little paralyzed, a little perplexed when it comes to like, okay, what should I do? Because a few decades ago, you just had a pension, right?
Yeah.
So
Yeah.
it's
Easy to get
definitely a
that.
different point.
Yep. Easy to get that analysis paralysis when you have too many options to choose from. And,
Totally.
generally having options is a good thing, but, if there are too many, it's kind of hard to know where to start. And so that's where, having a cash flow plan and just a financial plan in general can be super beneficial.
Super. Yeah, absolutely. And, really, I think what we want to do next then is at least give people some framework today and really from an efficiency standpoint, what makes sense to invest in first, given the different options you might have through your employer, given the different options that are there from a benefits standpoint, where should you direct your money in? Some obvious disclaimers that I should put on here, it's going to depend on your situation. But I just want to walk through some of the efficiencies with these. So, okay, should I do, should I match my 401k first or do my ESPP? Or should I, pay off high interest debt first or should I put money towards an HSA? So I want to talk through that. But another disclaimer just on here, uh, behavior and math are not the same thing. So math is not money. Otherwise we'd all have six packs and like 17 houses, right? Uh, it's, there's a human behavior that's a component of this. So there might be something that just works better for you from a mental accounting standpoint that doesn't line up with these efficiencies. But again, these are not direct recommendations. It's an order of operations here. The first place then I look after somebody has kind of filled up their cash, they have some checking savings money, and they have the correct insurances in place. Is the company providing a match on their 401k? And I think most people tend to look there first. Um, if you think about it, if you get a dollar for dollar return for 3 or 6%, let's just say, that's 100% rate of return the first day you put money in there. If it's a 50% match on every dollar you put in up to 3 or 6% or whatever it is for your company, that's a 50% rate of return day one that you put the monies in there. Until I find another investment that's going to give me that type of performance, it's going to be hard to argue that's not the best first place to look to invest your money. Okay. Um, Now, of course, the market could drop while that's vesting, the employer portion that they're putting in, but your employee portion is technically yours, right? That's yours the day that you put it in. So, other contingencies, if you're leaving the company in the next 6 months or so, it might not be the most efficient way to put money in there if you're not vested yet. That is, if you got a few years left, or if you need to currently post bail and you're detained. Maybe that's another one that supersedes it. But otherwise, I think you might agree here. Matching 401k probably the best first place.
Absolutely. Yep. I mean, that's free money your employer is giving you, right? In addition to your regular compensation. So it really is the great first place to start and, just kind of guarantees that you're setting off your retirement savings on the right foot.
Yeah, yeah. Next spot that I tend to look is high interest debt. So if you have debt that's maybe over 7 or 10%, again, this depends. I know interest rates are changing. Um, so not only can you get a guaranteed rate of return by paying that off the day that you do, because if it's a 10% interest rate and you're getting rid of it, like you would have been charged 10% on that over the year. Uh, that's a pretty good guaranteed rate of return. But also there's something that's undeniable here in the mental accounting. Just like, hey, I understand that it might be more efficient to put money elsewhere, but like the feeling that you get just knocking away debt and feeling like you can just drive towards that numerical goal that is clearly illustrated by whatever debt that might be there. If you have a $10,000 student loan that's at 10%, you're just like, I got to get rid of that, but I know what it is. It's clearly defined. That can help you. The other thing here that's important to just mention is it can hurt your credit if you're paying all these different loans and they have significant interest rates. So that's another benefit. But the second place I usually look is just high interest rate, high interest rate debt, right? Now the third tier here, and I'd like to talk to you about this a little bit too, because I know financial planners can address things differently at times. But I call this third tier the "it really depends" category, right?
Mhm.
So as I mentioned in the beginning of the episode, you're going to be given likely a host of benefits through your employer. You got an HSA, potentially an FSA, an ESPP. You might have some other deferred compensation plan. You might have a Roth IRA that you're looking at just doing personally on your own or maxing out other retirement accounts. But for me, the first place I look is there a match there with the HSA? Because if there's a match there with the HSA, we know that it's the only account that has triple tax savings. Tax deduction putting it in, tax deferment on the growth, and tax-free distribution when you pull it out. I don't know if you'd agree with that, but that's probably the first place that I'm looking is if there's a match on the HSA.
Absolutely. Yep. The HSA is one of my favorite accounts. I just don't think there's another one out there that has quite the punch that account packs, just like you said, with the triple tax advantage. And even more so, I love it because it kind of does, in addition to your health insurance you get through your employer, it really does help prevent against those catastrophic, if you will, health events that could happen, those big expenses that can come up if
Right.
something drastic happens to your health. And so that's a huge benefit. But more and more, we're seeing a lot of our clients actually saving their HSAs and using them actually as another retirement vehicle, right? So if you
Yeah.
don't need it throughout your life, your working years, as you are paying down, or excuse me, as you're paying for your health expenses, if you're able to
Hmm.
pay for those out of pocket and then you're able to save your HSA for your retirement, you can use that in retirement. You're just taxed on it just like you were a regular IRA. So there's
Yeah.
really no disadvantage to using it that way either. It's just another way to, defer those taxes now, which is great for our high earning clients. And
Yeah.
yeah, it's been a really huge benefit for those people, particularly.
Yeah. Yeah. I mean, again, there's just not really anything out there that has triple tax savings and the ability to use it in retirement. And if you actually, this is one kind of hack of sorts. If you held on the receipts while you were just in your pre-retirement days, let's say, and you just paid for your health expenses out of pocket, there's a rule to where you can reimburse yourself at a later date from the HSA. So you can keep it in there and then tax-free distribute decades later if you wanted to from that HSA. Again, that's another hack. It's just these things are just great vehicles if you have access to them. Now, again, you might not want to do that if you got some big insurance costs that year, and it's maybe better to have a different insurance plan because typically you have to have a high deductible plan to use the HSA. So, as I mentioned, the "it really depends" category here. The next place that I look is the ESPP. So, why, if it's a qualified plan, you're probably getting some discount here that's significant, 15%, let's say, that's guaranteed a lot of times if there's what's called a look back period, even though a lot of companies are doing away with that. So make sure if you have an ESPP to check what is the look back period here. But the ability to get an automatic 15% rate of return essentially by putting money into the ESPP is a fairly large benefit. And of course, after the ESP is sold, vested, right, you can take those monies, put them maybe in more tax efficient vehicles. So there's a lot of ways to really leverage this benefit. Missteps I see are people buy the ESPP and then they just let their stock sit there, and over time they have just this massive position in their company stock. But I don't know how you feel about ESPP, but again, a huge, huge benefit there.
Yeah, that's exactly what I was going to say, Mike, is the only kind of drawback with that is you might find yourself getting over allocated or,
Right.
putting all of your eggs in one basket, if you will, with regard to your company's stock, because you already work there, you're getting your primary form of compensation from them. And so, if you ever lose your job and then, the company stock also goes down, it's just a double whammy there. And so you
Yeah.
are increasing your risk there by having that lack of diversification. But like you said, another great vehicle, if you really believe in your company, think it's going to go up in the future, you can buy it at a discount. It's a great option.
Yeah. And, as you mentioned and pointed out there, there is a risk of concentration, and it's important as always, we can't avoid risk. It's just a question of how do we measure it so we can manage it, because there's
Mhm.
risk to just keeping it in cash. There's risk to putting money into a 401k, right? There's risk everywhere. It's just a question of how do we measure this risk so we can manage it and bring it all
Mhm.
together, right? Um, Next spot that I typically look, is there any other company benefits there? Beyond just an ESPP or the traditional stock options and HSA that you might see. Any other company benefits? Obviously, check those out. That's going to really depend. And then finally, for the it really depends category, if you still have access to a Roth IRA, if you're not phased out of that, um, certainly to consider that, and just maxing out your retirement accounts. So before you get into maybe, you know, saving for your kids' college or anything like that, kind of making sure you put the, air mask on yourself on the airplane before, start paying for all your kids 529. But again,
Right.
here financially, kind of similar. It does make more sense to put the mask on yourself first here before you start looking into college funding. So I don't know how you feel about
Yeah.
that.
Yeah, and I would just say, another factor there is you can take out loans for school, right? It might not be
Yeah.
ideal, but you can do it.
You can't
Versus
finance
you can't really
retirement.
take out a loan for your retirement. Yeah.
Yeah.
So,
Great point. Yeah, great point. Even though people have, a really, negative feeling there about financing their kids' college, but you do have that option, and they do have that option. And ideally, they're going to college to get a good job to
yeah,
hopefully pay for those loans. Doesn't always equate that way. And this is where, yeah, there's behavior and then there's what mathematically makes sense. Right. But one other thing too with that is like, if let's just say that money that was used for college could have been used for retirement, your kids then are probably liable to take care of you in some way if there's not enough money there for retirement. Right. So it
mhm,
comes full circle. It's not like you get rid of the problem. It really does depend again. So I don't want that to be a direct recommendation, but that's kind of the category for the it really depends. The next place that I look is the advanced planning strategies, and we can really start to feel the complexity come in here. You have, let's just say, maybe an after-tax option with a company that you can turn into what's called a mega backdoor Roth, right? You maybe have college planning needs, like a 529 account that you're considering. Um, you also maybe have legacy planning decisions that you're thinking of, right? So we're kind of in this like wealth accumulation phase where we've got a lot of the things checked off, but now it's like, okay, how do I still remain efficient with the rest of my monies if I have more money to save? And again, whether you save to a 529 here in this kind of tier four advanced planning strategy category, or a mega backdoor Roth or some other just option, uh, it will depend on, again, what your goals are, what you outlined as really that first step, right?
absolutely. Yeah, and I would say too, the whole study of economics, right, is scarcity, right? How do we use our limited resources to achieve an unlimited number of, goals, needs, wants? And so, you might find that, okay, I've fully funded my retirement accounts. I'm feeling good about that. I'm able to pay for my kids' college expenses. I feel good about that. What's next? And it might just be, dreaming a little bit and figuring out, okay,
Mhm.
what would I like to add to my life? How can I, add more good value to society, right? And that could be through, charitable contributions, starting a foundation. There's
Yeah.
so many ways you could go with that. If you've, checked all your boxes, you've put your air mask on, you've put your kids' air mask on, and now
Yeah.
you're like, okay, who else can I help?
Totally.
This is a great segue into that.
Yeah, yeah. I mean, after you kind of step through, again, as you just outlined there, the wealth accumulation, kind of like how do I really make, my plan efficient and really maximize, the growth for my overall net worth. Um, overarching all of this is, okay, are you giving back, and do you have a desire to give back while you're living? And I think a lot of times, like, it's really interesting, the psychology on this. Again, I'd be curious what you think of this, but it's like, when you're first starting out with income, it's like, I can't give anything because I need all the money that I can make. I don't have a lot of money. And then you maybe start making more money. And let's say you make even just $100,000, $200,000, and you say, well, I can't give 10% of my income because that's a lot of money now. That's like $10,000 or $20,000. And if you're making even more than that, it keeps going up. So there's always a reason why you shouldn't give back, right? There's always a reason why some percentage of your income doesn't make sense to be purposeful for others. And this isn't like some, soapbox to say that you need to do that. It's more just a realization that I've just kind of personally had on my own. I didn't know if anybody else has kind of felt that, where it's like there always kind of feels like this gut feeling like, well, it's just right around the corner when I'll be ready to start living intentionally by giving back some of my monies, right? But I think that overarches all of this, as far as like, yeah, there's what mathematically makes sense for yourself, but also what makes sense for others.
Right. Yeah. And I think that does go back to your own personal goals and also your value system, right? Because, maybe it's worth it to you to fund your kids' college education first or give more to charity first. And you're willing to work a couple more years because of that, because that's your priority, your value system. And so that's another area where it really depends. But I'd also say, doing the exercise of, figuring out exactly what you have, tracking it, what are my inflows, what are my outflows, can really help you, start living that life of purpose today,
Yeah.
right? And just even knowing what your goals and objectives are can help you, wheedle that in today, even if
Yeah.
you might think, oh, I don't make enough or I make too much to start doing this practice. I mean,
Right.
really the exercise of knowing, being organized and knowing exactly what it is that you have can help you, kind of outline what those values and goals are and help you implement them
Great
today
point.
rather than waiting for the next step.
Great point. Yeah. Taking inventory and really taking time to kind of think about, like, what is the purpose of all this? Like, what is
Mhm.
ultimately the meaning of just, all of this? If you're accumulating all this money, like, is it really just to live as efficiently as possible and maximize your wealth? Or is there some decision? And I certainly don't mean to virtue signal by saying this, although it might seem that way. But there is an unbelievable feeling that you have when you sit down and you say, a percentage of my money wants to go here, and it's not you
Mm.
or the IRS.
Yeah.
um, so hopefully you found this helpful. Again, the order of operations, it greatly depends for each of us. Certainly depends on what you want to do. But I always come back to, there's a money equation, there's a money formula for all of us, as far as how do we efficiently maximize our wealth given the options that we have available, and how does this all come together in the most efficient way. And so, again, hopefully you found this helpful today. If you're a do-it-yourselfer, if you feel like you need a guide, always, we're certainly here to help you. Again, my name is Michael MacKelvie. I'm a certified financial planner with Mariner Wealth Advisors. Abby, thanks for joining us today.
Thanks for having me, Mike. Great talking with
Yeah.
you.
Of course. You guys take care.
Mariner Wealth Advisors, or MWA, is an SEC-registered investment advisor with its principal place of business in the state of Kansas. Registration of an investment advisor does not imply a certain level of skill or training. MWA is in compliance with the current notice filing requirements imposed upon registered investment advisors by those states in which MWA maintains clients. MWA may only transact business in those states in which it is notice filed or qualifies for an exemption or exclusion from notice filing requirements. Any subsequent direct communication by MWA with a prospective client shall be conducted by a representative that is either registered or qualifies for an exemption or exclusion from registration in the state where the prospective client resides. For additional information about MWA, including fees and services, please contact MWA or refer to the Investment Advisor Public Disclosure website at www.advisorinfo.sec.gov. Please read the disclosure statement carefully before you invest or send money. The views expressed in this podcast is for educational purposes only and do not take into account any individual personal, financial, legal, or tax considerations. As such, the information contained herein is not intended to be personal, legal, investment, or tax advice. Nothing herein should be relied upon as such, and there is no guarantee that any claims made will come to pass. The opinions are based on information and sources of information deemed to be reliable, but Mariner Wealth Advisors does not warrant the accuracy of the information. Asset allocation diversification is a strategy designed to manage risk, but it cannot ensure a profit or protect against a loss in a declining market. Certified Financial Planner, trademark, CFP, registered trademark, and federally registered CFP with flame design marks, collectively the CFP registered marks, are professional certification marks granted in the United States by Certified Financial Planner Board of Standards, Inc., also CFP Board. The CFP registered trademark certification is a voluntary certification. No federal or state law or regulation requires financial planners to hold the CFP certification.